For more on the Bank of Canada's interest rate decision, let's bring in Royce Mendes, Managing Director and Head of Macro Strategy at Desjardins. Royce, thanks very much for joining us.
My pleasure.
Your thoughts on the decision to hold. Is there anything else he could have done at this point?
I don't think there was anything necessarily that the governor or the governing council needed to do on interest rates differently, but we did recognize that there was a notable shift in the tone of the communications. Late last year, they introduced this forward guidance, which suggested that the Bank of Canada planned to remain on the sidelines for the foreseeable future. We thought that was a bit misguided insofar as the uncertainty about the path forward for the economy and inflation was so wide that you couldn't really have any credible guidance. And now you see that the Bank of Canada seems to have walked that back. They introduced more language about the uncertainty about the economy moving forward with regards to CUSMA or with regards to geopolitical events. They seem to introduce more language that suggested that the current state of the economy is pretty fragile. And they recognize that upside risks to inflation aren't that great. So in a way, I think they acknowledge that in the near term, if there was a risk to the path for policy rates, it's to the downside. I think if the Bank of Canada was going to do anything, our forecast is that they remain on hold for this year. But if they were going to do anything, if they were forced into action, an economic shock would likely cause them to cut rates in the near term. And I think they sort of acknowledge that a little bit more in today's communications.
And what you heard, were the markets glad to hear him showing a little more direction and a little more focus?
Market participants seem to interpret the communications in broadly a similar way to the way I just described it, that the Bank of Canada sounded, in a word, more dovish about the outlook and more humble about their ability to forecast where the policy rate will be and what is appropriate for the current juncture. I think there's a lot, number one, of conflicting signals, but the end conclusion about the state of the economy is that it's still not anywhere near full health. And if, even if the current policy rate can get us there, it'll take a long time. And so, market participants are still pricing in a small chance of a hike by the end of this year, but those chances have really diminished today and in recent weeks as we've seen the data flow sort of confirm our hypothesis that the state of the economy is not something that we should be cheering about, even despite the fact, not that many months ago we saw a big drop in the unemployment rate. That was really just due to the volatile nature of the data, and we saw that almost reverse as quickly as it showed up. The economy is very fragile at the moment, and upside risks to inflation don't seem that important. If anything, over the course of the next 6 months or so, we have to be worried about guarding against the economy deteriorating and getting weaker. And some of these trends that we've seen, whether it be in the housing market or in trends in consumer spending, deteriorating to a point where the bank has to move back off of the sidelines and return to rate cuts again.
What are your thoughts on the fact he said they've factored in the possibility that the tariffs are here to stay, even with CUSMA negotiations coming up? I mean, that's probably, a worst case scenario, but that's how they're looking at it.
Well, I don't actually think it's a worst case scenario, because if you look at the tariffs that were included, they're not that high. It's just the current tariffs that we have. And as the Prime Minister likes to say, Canada has the best or one of the best trade deals in the world with the U.S. based on the CUSMA exemption. So based on the CUSMA exemptions, they've assumed that the other tariffs remain in place. And I don't think they're low to mid single digits on the overall amount of goods passing the border. So I mean, worst case scenario is that the U.S. withdraws from the CUSMA agreement, and the 35% tariffs that are now being applied to a small section of our goods exports hits all of our goods exports. So that's worst case scenario. This is sort of middle of the road. This is not the upside scenario where we come to an agreement with the U.S. and with Mexico and free trade reigns supreme again. This is sort of the middle of the road, what they've built in, and I think that's probably appropriate, with the caveat being that we really don't know what the trade situation will look like 12 months from now.
Let me get your thoughts on his comments on Jerome Powell on the importance of a strong independent Fed south of the border. It's good for Canada. Is he getting into politics there, or is that something that he needed to say?
I think he's right to point out that an independent Fed, insofar as that it contains inflation while at the same time promoting maximum employment in the U.S., is good for Canada. And if the Federal Reserve can continue to do that, it means that, you know, the environment for Canada to grow in and to prosper in is still there. If, you know, we saw the independence of the Fed begin to deteriorate, what you would likely see, and what we've seen in most other nations when that happens, is that inflation starts to rise. That would not be good news to the country that, you know, still sends a huge portion of our goods straight south to the border. And some of that inflation would actually spill over here and affect us here in Canada. So I think, you know, the governor is right insofar as he's addressing the current state of monetary policy and some of the risks around the future outlook for monetary policy, to acknowledge that it is extremely important that the Fed retain its independence as we progress through this year and as the Fed passes some of these hurdles with regards to appointing a new chair and some of the possibility of changing of the Fed's Board of Governors.
Okay, we have to wrap it up there, but Royce, thanks very much for joining us.
Thank you.
Royce Mendes is Managing Director and Head of Macro Strategy at Desjardins.